I'm excited that we're going to have Jeremy Valdez from DZA here. So he has been with DZA since 2016 and has a decade of experience serving healthcare and not-for-profit organization. He specializes in providing comprehensive accounting and auditing services in accordance with our AICPA and Yellow Book standards. Gosh, I haven't looked at those in a while. Jeremy's expertise includes financial statement audits and preparations, employee benefit plan audits, single audits performed under OMB, and Medicare and Medicaid cost report preparation. Love a fellow auditor at heart. It's awesome. All right, so I'm going to turn it over to Jeremy, and we're going to kick off this session. Oh, yeah, go ahead, clap. I just remembered one other thing. If you're a provider and you visited Waystar booth, I've got the tickets, so come see me. Thanks, Jeremy.
All right, thank you. As you said, my name is Jeremy Valdez. I am an accountant with DZA, an accounting firm here in Spokane, Washington. I have been with them for about 10 years, and I am a manager, and I do specialize in hospital financial statement audits, not-for-profit financial statement audits. I also do employee benefit plan audits and single audits. And within all those audits, some of the things that we look at in every single one of those is internal controls. So I'm going to talk to you about that today. All right, so internal controls, what is it? Internal controls, as defined by COSO, the Committee of Sponsoring Organizations from the Treadway Commission, is internal control is a process. It's affected by the entity's board of directors, management, and other personnel, and is designed to provide reasonable assurance regarding the achievements and objectives relating to operations, reporting, and compliance. Whew, I'm willing to bet they took a few weeks to come up with that. So I'm sure you're guessing, like, who is COSO? Why are we listening to them? Why should this be the definition for it? And COSO is an organization that was established many, many, many moons ago, maybe before I was born, maybe not, because I forget how old I am sometimes. But they were set up to help organizations kind of understand how EMR management works, understand internal controls, understand how to set up fraud deterrence and governance. Way back in 1992, COSO came up with this internal control framework and to give organizations some guidance on how internal controls works. And that same framework is still being used today globally. So, internal controls. To add on to the definition, internal controls is a system. It's established by management, and it's presented to the board, and the board usually approves it. And it's a set of policies and procedures that basically tell how does your organization work. Every facet of your organization should have some policy or procedure that dictates who does what, who oversees it, where does it go, who reports to who. All of those things are part of your policies and procedures, and within your policies and procedures, there should be internal controls. And your policies and procedures should be designed to do a few things. One of those things is to protect the organization's assets. They should also be designed to manage risks from things such as theft or negligence, and they should also be designed to ensure that your financial records are reported accurately so that the organization can make good decisions about what to do in the future. Policies and procedures should also be designed to protect, detect, and correct errors from happening. They should also be designed to protect and detect negligence from happening from those who are performing those procedures. And they should also be designed to protect from fraud from those who might be out to steal or misuse items within your organization. But before we dive into all that, I think we should kind of understand why we should care that we have internal controls and why we have them set up and why we should be performing them, reviewing them, and making sure they are doing what they're supposed to. So one reason is for public accountability. As most of you are probably part of organizations that are either governmental or not-for-profit, you have some public accountability. You have a duty to the public and a fiduciary responsibility. As a governmental or not-for-profit organization, you are supposed to be acting in the public's best interest, and the public should feel that you are doing that. And by having policies and procedures and working your internal controls, they should have that faith that you are doing what you are supposed to be doing. Your organizations are also set up to serve the public. Your public comes into your facilities to get care, and they should feel like trust that you are performing care to the best of your ability and that they're going to get the care that they deserve. And also, as governmental and not-for-profit organizations, you are receiving public funds, whether it be from the public coming in and receiving services. There's also federal funding that comes through your organizations. There's state grants, Medicare, Medicaid. You're receiving funds from them as well. And then, so you should have, the people should feel good that you are treating those assets correctly. So effective internal controls help safeguard your assets and provide assurance that the public funds are being treated appropriately. Sorry, it's been a while since I've spoken to a crowd this big, so give me a second. So another reason to care, it's job security. As many of you are probably in management, or if you're the one doing the work, having proper internal controls set up in your organization and carrying them out effectively will help to protect and detect any errors from happening. I don't know how many of you have heard of hospitals or other organizations that are not run very well. And usually one of the main reasons for that is because their internal controls aren't very good. They're not being followed appropriately, or people aren't watching and reviewing and making sure that they are doing what they're supposed to. So your internal controls with the policies and procedures help your organization run smoothly. It tells everybody, this is what you're doing, this is how you do it, and then you should have management or anybody else reviewing to make sure that this is what's happening and this is who's doing it and that they're doing it appropriately. And it also allows them to catch anything that might be going wrong or that's been done incorrectly. Internal controls also ensures that your reporting, your financial reporting, the statistics are all being reported accurately, because from a management level and a board of directors level, that information is used to make decisions as to, do we hire more? Do we need to let people go? Can we add another service line? Do we add another doctor? Do we add more nurses? Any of those decisions. So if you have your reports and your financial data is accurate, then it'll help those decisions be made in a way that's going to help the facility. And then on an individual level, it is also important you should care, because it tells you what you're supposed to do. It tells you what your job is, and if you follow them correctly, the policies and procedures, then you are doing your job right. And nobody wants to be known as that person that doesn't know how to do their job, right? I'm looking at my coworkers right now. And another reason to care is to remain in compliance with the external authorities. As healthcare organizations, there are a lot of external authorities that are wanting to know what you're doing and how do you do it, and are you following our rules when you're doing it. So if you are receiving Medicare funds, they have their own compliance requirements. If you are receiving federal grants, they have their own compliance requirements. If you have debt, large debt out there, they have their own compliance requirements. And by having good internal controls and policies and procedures set up within your organizations, you're less likely to fall out of compliance. And I don't know if any of you have fallen out of compliance before, but typically that means you're going to end up having to do more work to shore up those deficiencies that those external authorities have said that you have to clean up. And nobody wants more work. Okay, so now we know why we care, and we know what internal controls are, but what are they supposed to do? And so here we're going to look at three different objectives of internal controls. Within operations, they are supposed to help the effectiveness and efficiency of operations. This means that every facet of your organization should have a policy and a procedure that dictates who does what, and it should be followed. And on top of it should be followed, management should be overviewing and reviewing that those policies and procedures are being followed. When followed correctly, internal controls helps keep your assets of the organization safe from misuse or loss. I'm pretty sure that using the MRI machine to figure out which coins are magnetic is not an appropriate use. So policies and procedures should keep that from happening. In reporting, internal controls helps keep your reports accurate and your financial data accurate. As I said earlier, this helps with decision making, but not only for you, also for those external authorities who are requesting all of this data from you, and they got to make decisions as well. Decisions such as, do we give this organization more money? Do we have enough money to hand out? And you never know, one of those decisions might be, do we pay you more money? That's a good decision. I like that one. And then the other objective of internal controls and policies and procedures is compliance. Compliance with those external authorities. Compliance with your debt covenants and your federal grants. Because as I said, it creates more work if you fall out of compliance. All right, so there are three types of internal controls that we're going to look at that you can have implemented within your organization. Preventative controls are those that keep things from happening. You ask yourself, what could go wrong and what can I put in place now to keep those sort of things from happening? Detective controls is another internal control that you can add into your policies and procedures. Detective controls are put in place to be able to look back and see if anything went wrong with the procedures that we put in place, and then give you the opportunity to go through and correct them. When you're talking amongst managers and the board, you should be kind of looking at what you have in place and deciding, are there enough controls? Are we preventing stuff from happening? And are we reviewing things to make sure we catch anything that might happen? So when you're having those discussions, you might look at, where is it most important? Where are we most vulnerable? And what can we do to kind of shore that up? And that kind of goes into the mitigating controls. Mitigating controls minimize the impact of something going wrong. All alone, mitigating controls aren't the best controls, but they are great to have to supplement your preventative and your detective controls. Preventative and detective controls are great all by themselves, and we're going to look at a couple of examples here in a second. And I keep watching that clock, and it's not moving fast enough. You guys back there do something about that? I don't think so. Okay, anyways, types of internal controls. So as we said, preventative, detective, and mitigating controls. So within your preventative controls, you have things like training, segregation of duties, pre-authorization, pre-approved vendor listing, and basically with training, for instance, if you train your staff well and they know what the policies and procedures are and they follow them correctly, there's less likely chance of something going wrong. A pre-authorization would be like POs having to be signed before they get paid. like billing write-offs have to be approved by management before they're actually written off the system, because things like that, you end up losing money. For detective controls, you're looking at balance sheet reconciliations, management reviews, and physical inventory counts are sort of detective controls because they're looking after the fact, going through and seeing if anything did go wrong. So your balance sheet, looking at cash reconciliations and seeing that your cash matches your GL, and if it doesn't, what's going on. With management, reviewing the stuff that your staff is working on, then they're able to catch any errors that may have happened or negligence. Sometimes some of our employees are lazy and they're not doing what they're supposed to. So you catch those things and it gives you the opportunity to coach and correct those errors. And then you're mitigating controls like dual signatures on checks is a big one. And I don't mean where you print the check and it already has a signature on there. That's not a dual signature, but having two people sign your checks is a better protection than just having one person, because people are sneaky and do sneaky stuff, and we'll talk about the sneaky stuff later. Also, internal audits. So for those of you, your billing department, you might pull a few bills from that were recently sent out and make sure all the charges are on there and that there aren't extra charges, because patients don't like to be charged for something they didn't get, and make sure there aren't charges missing because that's leaving money on the table, and we don't want to leave money on the table. All right, so we're going to go back to those COSO guys, and we're going to look at the framework that they put together. And I don't know how many of you have been through an auditing class. I know you guys have, but the rest of you, I'm not sure. But this little picture here, it drove me nuts for a little while I was in class, because I thought I had to remember every word that was on there and where it went and how it worked. And that's not what I needed to do. And I also had the internet, so I could have always looked at it later. But for those of you, here you go, a little trip down memory lane. But the COSO framework that was established back in 1992 had this pictogram up here to kind of help people understand how internal controls works and how things are integrated with each other. So looking at the front face is the list that's up there, the control environment, risk assessments, control activities, information and communication and monitoring are there on the front face, and then on top and on the side are some other components of internal controls. And the idea behind the picture is to say that all these things work together. So if we take the top one with the control environment and we look across the top, which is I'm forgetting what it is already. See, I'm back in school. Operations, reporting, and compliance, they work together. So when you're looking at control environment, you're also thinking about those things as well. Along with, on the side, is the different levels of the entity, from the top going all the way down to how does a check get recorded and entered into the GL. So we're going to look at each of these as we go along. I keep forwarding this one, and it's supposed to be that one over there. All right, internal controls, components. So control environment. This is an overarching control. This looks at the entity as a whole and looking from like the top down. Here, this is about how is the organization run. Is the board actively overseeing and monitoring management? Is the board involved and engaged in the operational decisions of the organization? Is management overseeing staff? What's that like? Does management work with staff to improve? Or is management overbearing and micromanaging? That's looking at the tone at the top, and I'm sure you've heard that before, and it's a very real thing. How management runs the organization will determine how the staff behave. Does management act with integrity? Do they have ethical values? Do I, as a staff, believe they do? Because if I don't, then I might not act that way either. How does management correct or reprimand or implement things in their departments? How do they treat their department heads? However, the management treats department heads might be how department heads treat staff. So we're looking at the overall culture of our organization. And from the top down, if we treat people right or better or in a positive way, then that'll trickle down and hopefully make a work environment that's more enjoyable to be in and will make me less likely to want to steal from you. It's kind of like being a parent. And, they say if a kid hits when they're in kindergarten or when they're younger, it's probably because their parents hit. I like to think of it as when I'm driving down the freeway and I'm going a little bit faster than I should, but I see a police officer in my rearview mirror. I slow down to about 63, 64, trucking along. But when he zooms by me at 75 without his lights on, I'm like, well, it must be okay, right? It's kind of the tone at the top there too. So I follow that rule. He's going 75, so am I. So the next component on the internal control framework is risk assessments. And this is something that should be ongoing and done at all times. Management and the board should always be looking at what are the risks that we are seeing within the organization, within different departments, anything that has to do with our finances, with our reporting. They should always be looking at those things and trying to decide, do we have appropriate controls, policies, procedures to mitigate any issues that might come up in those areas, and what can we do to keep them from happening or find out they happened and fix them. Management should also be having these same discussions with their department heads and with staff so that everybody is always thinking about it and trying to improve. Because as I said earlier, internal controls is a system. It takes everybody to make sure that it continues and it works well. So some questions that you might ask when you're in a board meeting or when you're meeting with your manager or with the CFO or whoever, or what are some obstacles or potential problems that could prevent the entity from achieving its goals? Or how could someone commit fraud within the entity? That's always a fun question. When I first started my audit career with DZA I think it was like my second audit. I was walking along with my manager, going through the hospital. We're going to go into our little room to start working on our computer, and he just kept chanting, "Find the fraud, find the fraud, find the fraud." I was like, "What?" He's like, "Find the fraud. That's what we're doing, find the fraud." It's not really what we're looking for, but we are at the same time. So with that said, oh, wait, not that one. Wrong button. Fraud in the wild. So a man bought a Fabergé egg online at the deal of a lifetime for 60 pounds. It turned out to be a potato with earrings. He claims it ruined his marriage. And I don't know, a potato with earrings looks pretty good though. I think I could put that on my shelf and nobody would know the difference. All right, so since we're talking about fraud, talking about risk assessment, I'm going to go over the fraud triangle with you because it's something that we should think about. Because fraud is a tricky little thing to discover. Fraud is usually not something that is intentional or that is accidental. It's usually deliberate and intentional, and people can be sneaky. So here we're looking at what's called the fraud triangle theory, and it says that fraud usually requires these three things. It requires motivation, rationalization, and opportunity. So your motivation is the reason to want to do something. Your rationalization is the excuse you make up to do something. And the opportunity is that chance to do it. All right? So motivation and rationalization, those are things that are internal. It's really hard to guard from that happening. If somebody has the motivation within themselves to commit fraud, to steal, to misuse, to lie, to cheat, you can't really do anything to stop that. Same with the rationalization. If I tell myself that I deserve it, then I'm going to do it, and there's no control really that you can put in place to stop it from happening. But there are some things that we can do to kind of dissuade it from happening, let's say. So some things that can be done is training of individuals on ethics and appropriate behavior. As said earlier, I am a CPA. I have to maintain my license every 3 years. We got to do so many CPE hours, and we have to do 4 hours of ethics training. And so I'm coming up on my third renewal, I believe, and so this will be my 12th hour of ethics training. And it's the same class every time because it doesn't really change, but it's something that we have to go through, and it's good to have your employees go through it as well, just so they have that thing in the back of their head saying, maybe I shouldn't do this. The other thing, another large factor that would help with your keeping your staff from doing any of these wrong things would be the tone at the top. How do they see management? Is management being ethical, or is somebody in the management team taking a roll of toilet paper every week, and then your staff says, well, I can do that too. It's just a roll of toilet paper, right? It's not much, but if you have 200 employees and all of them are taking toilet paper, that starts to add up after a while. But the one thing that we can kind of guard from is opportunity. Opportunity is something we can control mostly. And I say mostly because of that good old proverb that says, if there's a will, there's a way. So if somebody wants to make an opportunity, they probably will. But we can mitigate these opportunities by establishing written policies and procedures that are constantly followed and reviewed and overseen. By ensuring that the duties are segregated so that not one person has too much control over a certain cycle, and that they can't circumvent controls is a good mitigating control to take away that opportunity. So after the fraud triangle came out, there was another rule that was set out. It's called the 10-80-10 rule. And what it basically says is 10% of the population is good. They're not going to commit fraud. They're not going to steal. Doesn't matter what's going on in their life. They are never going to ever commit fraud. And then there's 10% of the population that's bad. And they're looking for every opportunity to take what's not theirs and do whatever they can to get more. And then there's the 80% in the middle. And the 80% in the middle is usually good until something happens, some sort of motivation that might make them decide, can they find an opportunity to take from you, whether it be a roll of toilet paper or money. And motivation is a strong factor. Money is a strong factor, whether they're having problems with debt at home, or if they wanted to advance in their own work, those are good motivators. Or if they don't want to lose their job, those are good motivators too, to have them fudge numbers, try to say something was done that wasn't done, and find some way to take your money also. So when you're looking at your internal controls within your organizations, when you're reviewing them, when you're updating them, one of the things you want to do is kind of plan for that 80%, because the 10% that are bad, doesn't matter what you do, they're gonna try. The 10% that are good, you don't have to worry about them. So you're just looking at that 80%. And what are some different ways that we can keep them from having the opportunity to commit fraud? So a number of years ago, and I haven't caught any fraud myself in the last 10 years, but about 5 years ago, I was starting an audit, and during every audit, one of the first questions we usually ask the CFO, CEO, and the board is, do you know of any fraud? Have there been any alleged fraud or any suspected fraud? And 99% of the time, the answer is no. And I love that. No means I don't have to do more work. But this one instance, they said yes. And I was like, oh no, what does that mean? It was fraud that they had found within their organization that they caught themselves, so I didn't have to do any extra work, luckily. But it was the dietary manager was making purchases through the hospital to be able to fund her own catering business outside of the hospital. And it took them about 6 to 8 months to discover that this was happening. And the way they discovered it was somebody was going through invoices and noticed that there's a certain type of food that was coming up on the invoices that they had never seen in the cafeteria, and they ate at the cafeteria every day. And after they started asking questions, that's when they discovered that that fraud was happening. And it was like $10, $15, $20,000, something in there after about 6 to 8 months. So fraud does happen, and it's a dietary manager. You're thinking this is a trustworthy person. We put them in control, and they were still had the motivation, and they made the realization or the rationalization that they deserved a little bit more, and they committed the fraud. So you've got to have your controls got to be in place so that you can hopefully detect those kinds of things. All right, fraud in the wild. This one's more fun than mine. In 2000, a North Carolina man purchased a case of rare, expensive cigars and insured them against fire damage. He then smoked the entire case and filed a claim that the cigars were destroyed in a series of small fires. Insurance refused to pay but lost in court on the grounds that they had failed to define what is considered an unacceptable fire. The man was awarded $15,000. Then the insurance company had him arrested for 24 counts of arson, for which he served 24 months in jail and had to pay a $24,000 fine. So as you were kids, you heard the words, crime doesn't pay. There you go. It's true. All right, so the next component of our internal controls that we're looking at are the control activities. Control activities have to do with the actual policies and procedures that are in place. And there are 4 functions of control activities that we're going to look at. We have your entity level control, financial close and reporting, activity level controls, and information technology. And we're going to look at them briefly. So here are some examples of each of those control activity functions. This is not an exhaustive list. It's just a small one. It's as much as I can fit on the slide. So for your entity level controls, we have things like board oversight of management, CEO selection, management oversight of daily operations. If the board is actively overseeing management and making sure that those policies and procedures are being followed, then there's a better chance that your facility is going to run efficiently and effectively. For the financial close and reporting, accurate preparation of monthly financial statements, and timely review of approval of revenues and expense transactions is very important. And I think that second bullet is more important than the first bullet, because if you're looking at information 3-4 months down the road and reviewing it and finding errors, then for the last 3 or 4 months you've been operating on bad information. Activity level controls, this is the detailed policies and procedures within the organization. So from the housekeeper, how they do their stuff, to the AP clerk, how they record the AP transactions and how checks are run. It gets all the way down to that. And the activity level controls is where we should be looking at our segregation of duties and making sure that not one person has too much control of what they do. Then the other function is information technology. More and more every day, we have technology is becoming a bigger part of our work environment. And as the guys that were up here earlier were talking about AI, it sounds like they're all going to be doing our jobs anyway. But if we control the IT department, the information technology within our organization through things such as authorization of who has access to what and changes to the system and reviewing that access, there's less likely chance of things going wrong within the IT system. The next component of the internal controls framework is information and communication. And this one's pretty important in the sense that all the information that you're gathering, whether it be financial data or statistics, should be flowing up and down. Staff should be discussing these things with management with the board the board back down to management, and management back down to the staff. The more information that gets shared between everybody, the better chance you have of understanding what's going on, finding errors, correcting them, and being able to report actual data that makes sense. And this also is important for that decision-making process that happens at the board meetings when you're talking about hiring, firing, adding, subtracting departments, and such as that, stuff like that. Oh no, we got another fraud in the wild. So an employee for a phone book company slowly stole over 100,000 copies over the course of 4 years. She was stashing them away in a storage unit for some unknown diabolical purpose. Estimated losses for the company were $500,000. That seems like a lot to pay for a phone book that shows up on your doorstep for free. And I wonder what she used them for. That's a lot of phone books. All right. The final component of the internal control framework is monitoring activities, and this has to do with oversight of the organization, review of internal controls that are presently in place, and evaluating them and their effectiveness. Do we need to make changes? What's going on here? How does this work? Management should be reviewing and assessing the effectiveness of internal controls all the time. Anytime there's issues that come up, they should be looking at them and saying, can we fix this? What can we do to improve it? Any issues discovered should be addressed in a timely manner. Otherwise, you are letting an issue continue on, and that could end up costing you money. And everything comes back to money. So if you find problems, fix them quick, fix them soon, fix them early, so that you don't have any losses in the future. All right, another fraud in the wild. A Texas man used an identity fraud scheme to obtain lines of credit from various banks. He used fictitious entities with combinations of the name Dewey, Cheatham, and Howe. He was caught when a bank vice president noticed the name on the money order request submitted to him for approval. Internal controls 1, fraudsters 0. All right, so now that we know what internal controls are, why should we care, what the components of them are, what are the objectives, we should probably look at what makes internal controls break down. So number 1, internal controls or policies and procedures are followed by people, and people make mistakes. Sometimes you could be having a bad day and you just didn't do something properly. That's not a problem. But sometimes people just make mistakes and you don't catch it until later on. But usually if internal controls break down, it's not just because of one person. It's a system. There has to be something along the way that allowed those internal controls to break down. So as we stated at the beginning, internal controls is a system. So you need to have that communication. You need to have that monitoring to make sure that they are being followed appropriately or updated as time goes on. So let's look at a couple of these. So management override of controls. That one, for every one of the audits that I perform, that is a significant risk in every single one. It doesn't go away. I can't delete it if I wanted to. And it's a problem, or not a problem, but it's a risk because management can usually just go in there and just click a couple buttons and say, that's okay. Can I write this off? It's over the amount that we're supposed to have so-and-so look at. Yeah, it's fine. They can basically have the keys to the castle and do what they want. So as an auditor, we apply additional procedures to kind of look over those things and make sure that management isn't overriding controls that are set up, that are already set in place. Employees ignoring different controls is another problem area. So that's where the review comes in. You go in and check and make sure that they are following the policies and procedures as they are laid out. And if they are not, find out why not and fix the problem, whether it be the employee or maybe it's the policy or the procedure that has an issue. We have found that, as I said earlier, more and more technology is being brought into our facilities, and some of the policies and procedures that some organizations have are 10, 15 years old, and they need to be updated for what's going on now. One-time, I can't read that from there. One-time exceptions that turn into a slippery slope. Those are fun because you might let somebody do something one time. You're like, it's okay, it didn't get caught. Let's do it again. Let's do it over here. Let's do it over there. So as management, you should try not doing those one-time exceptions because it can turn into a problem. And also your staff might start saying, well, we did it last time, so why can't I do it now? Kind of like your kids coming up to you and saying, you let me have a cookie last night, why can't I have one today? Because I don't have any cookies for you. Our next one is the misplaced trust in personnel with custody to key controls. So that one, trust is not a control. And I don't know if we can say that enough. Just because somebody's nice, somebody does their job well, doesn't mean you don't have to review their work and make sure that they are performing their duties as prescribed. So trust is not a control. You can't just trust somebody. You got to trust but verify. And then policies and procedures that are not documented. If your policies and procedures aren't documented, aren't written down, how is anybody supposed to tell me what I'm supposed to be doing? I just completed an audit recently for a nursing home in Colorado, and they're new. They're like it was a December 31st audit, and they had only been in operation for 15 months at that point in time. And while we're doing the audit, I asked for their policies and procedures, and they didn't have any at all. None. So it's like, how do you know what you're supposed to do? And it's, well, so-and-so says I do this. And so they do have internal controls. Somebody was doing the work. Somebody was reviewing the work. They were there, but they weren't written. So if their HR director, which is who I was working with because their business office manager wasn't doing her job and they let her go, once the business office manager was let go, it's like, how does the HR director know what she's supposed to be doing? There were no policies and procedures put in place. And throughout the audit, I had the board reaching out and saying, does this sound like a good policy? Does this sound like a good procedure we should have? It's like, I don't know, does it work? Does it do what you want it to do? So there were a lot of discussions on that. So having your policies and procedures actually written, reviewing them, updating them is an important part of your job as upper management of these healthcare facilities. And then the last one, policies and procedures that are out of date. Oh, well, we just talked about that one. So make sure you're going through them and updating them to fit what you do now. As your organization grows, then your policies and procedures will probably change along with them. So how do we keep these internal controls from breaking down? So the following are some mitigating controls that can be put in place to help reduce the risk of internal controls breaking down. So our first one there is review, review, review. And this is one that I think is the most important. You should be reviewing the work that's being done by the staff. Bank reconciliation is performed by the controller, so the CFO should be reviewing it to make sure it's accurate and complete. Billing charges are done by the billing clerk. Then there should be the business office manager or whoever oversees that department, making sure that the billings are correct and they didn't miss anything. Segregation of duties, we talked about that one. Some of you might have a problem on how to do segregation of duties if you have a smaller organization. There aren't enough people in the business office. I have an audit that I did a couple years ago where I was talking to the client, and I was like, your AR days are like way higher than they were last year. What happened? And she said, well, our biller died. I was like, okay, so put another biller in or have somebody else pick up the slack. But there was nobody else. They had one biller, and when she passed away, they didn't have anybody else to replace her. So some places are small enough to where that's the reality. So sometimes, even if you don't have enough people to be able to review, at least having a second set of eyes on the work will help keep problems from happening. Written policies and procedures, as we discussed, get those in place, make sure everybody reads them. Every year if they have to sign saying that they read it, whether they did or not, as long as they sign it, then you can come back and say, you said you signed this. And having those in place, and it also leaves less gray area for what their job is, so they can't circumvent the rules. They can't say, oh, well, I thought I was supposed to do this. Well, the procedure here says this is the way it's supposed to be done, and you should be following that. And then, like I said, trust is not a control. As an auditor now for 10 years, I feel like I'm skeptical in every part of my life now. My son says he did his homework. I'm like, did you? I can't really check because he's doing calculus and I never did that. So it's like, okay, yeah, sure. But trust is not a control. So always, always, always verify that the work is being done. Another fraud in the wild. A postal worker was paid for 144 days of jury duty, claiming it was an extended federal trial. He was actually excused before deliberations began, but fabricated the court paperwork to support his claim. They caught him when he tried to say the same scheme again 3 years later. Ironically, he pled guilty in the same courthouse he claimed to have spent 144 days of jury duty. Silly. Okay, and I have a couple of websites here that you can go to look at some more information for over internal controls. One of them is from COSO, the Committee of Sponsoring Organizations. We also have the Washington State Auditor's Office has a really good little blurb there on internal controls for the different sections, whether it be cash management, accounts receivable, AP. So it's a pretty good resource to look at. And then the AICPA CIMA website also has some resources for you to look at if you want to look into more information about internal controls. And that is the end. I can open it up for any questions if anybody has, because I went way too fast. I guess I'm going to have to do a song and dance up here for 10 minutes. Do it. Yeah, there you go. We got a partner over here. Nope. Anybody? Nope. Thank you. Thank you.
Thank you, Jeremy. We're going to make a donation in your name to the Ronald McDonald House here in Spokane, so thank you very much.